So today we'd like to start off with talking about forecasting, right? As a means of being the input of the valuation model that we like to use, right? Because kind of like after understanding everything, and ultimately what we want to get at is we want to value the firm. We want to understand, right? We want to understand like what the value of a firm is, right? This can have different purposes or different goals. So I mean, as we discussed at the very beginning, it has important implication for, for managers, for example, to understand whether their activities are value creating. It's very also, important for shareholders so that they, can better assess whether they should remain invested into a specific company or even increase their share versus, go out of the stock. It's also important for for creditors as well, right? So that they are able to assess the risk involved in their investments, right? Which in this case is of course the loan. So ultimately, right, we want to get at the valuation model. Forecasting is a means of that, which builds upon the financial ratios. So what I want to do, I want to talk about forecasting this week. They were focusing on the revenue forecasting process. And then I would like to already talk a little bit about valuation. Yeah? And then next week, I'd like to continue with the forecasting because it's quite a long and detailed process. And maybe we don't want to spend like 3 hours in a row talking about forecasting, but rather we want to build it from week to week. Okay, good. So as I said, forecasting is a necessary step in the process of valuation. What we're basically trying to do is we want to build pro forma future financial statements, right? We want to build kind of like how the financials of the company looks like in the next, over the next years, right? Okay, there are some principles that should guide our forecasting process, okay? And kind of like we want to produce, what we want to produce is a reliable and realistic expectation of the future, right? So we want to come up with, let's say, unbiased and somehow objective, numbers. We don't want to be too conservative. We also don't want to be too optimistic. This is our goal, right? This is our principle that it should guide this process. Okay, so it sounds, very logical. Of course, we want to be as accurate as possible. Of course, in practice, this can be a very daunting task, right? It can be very, very difficult to be truly unbiased and objective about a particular company, right? When you think about yourself, right? Maybe you're just excited about the business model. Maybe you're excited about, I don't know, the CEO and how he or she approaches, you during earnings guidance call or conference, right? So you can be, very often you're tempted to somehow, lose sight of that principle of being, unbiased and objective very, very easily. Okay, so it turns out that then therefore it's considered to be good practice. When you approach your forecast, that you maybe first approach it without, let's say, listening too much of what the CEO or the top managers say, okay, during their speeches or during the letters that they issue, or in their management discussion and analysis. So maybe it's better to start off with less direct information from the firm, okay, and then kind of in the second step only kind of double check whether what you think the company is going to perform going forward with how the management thinks that the company is going to move forward. yeah, so right, we don't want to manifest wishful thinking, and we want to be very detailed. Okay, it's kind of like you know, it's considered to be good practice if you are, you know, if we are more detailed, then we are more likely to be you know, accurate, or to come up with a good estimate of the future of a firm, right? Another principles that we want to maintain is that the assumptions that we take must be internally consistent, right? So if we, for example, think that the company will grow their, you know, its revenue by a lot, right? Then of course we also need to then project that for that growth, we're probably going to need a lot of investments, right? So so these assumptions that we, you know, take upon or follow with respect to, you know, to one, let's say, item should be consistent with other related items that come with it. Yeah. Okay. So yeah, what is a possible, let's say, game plan for forecasting? So the way I like to approach this task is through, you know, a so-called 7-step forecasting process, which was developed by Mark Bradshaw and Jim Whalen, two colleagues of mine. And it goes like this. So first, what we want to do is always, we want to project revenues first, okay? Question to you, why do we want to start with revenues? Why don't we start with, I don't know, projecting cash or projecting the investments, or, you know, why do you think revenue should be the starting point of our forecast?
Because of the cash flow, we need the cash flow to build the model, I think.
Because of the cash flow? Yeah, but why? Okay, so why don't you start with the cash flow then? Could start with the cash flow, right?
I think the revenue is directly connected to the core business, and we need the cash flow generated from the main business.
From the main business, yeah. And anything else you would like to add? I think Lirong is right by saying, okay, this is, I mean, revenue reflects our core operations, the result of our core operations, the money that we make basically from it, right? And so also a lot of what follows from the revenue, let's say, stream, affects the other items, right? So for example, right, if you have a lot of revenues, yeah, you are also likely to have a lot of cost of goods sold, a lot of expenses, yeah. Potentially you also are going to need more employees to, you know, to run all the processes related to your revenue stream, right? So actually a lot of the items that we see within the financial statements, they are like really actually directly, you know, correlated to the level and the change of revenues that we observe, right? And as you remember from our financial ratio analysis, we learned that, okay, when we analyze an income statement, often we even want to express items as a percentage of revenue, right? We want to learn like how gross margin, for example, has developed as a percentage of revenue. How selling, general, and administrative expenses have developed as a percentage of revenue. How the overall profitability, so net income, has developed as a percentage of revenue, right? So revenue is you know, such a important number, and therefore should be the starting point of our forecast. Yeah, and as I said, because a lot of the items are really, you know, directly correlated with what is going on with revenues. Yeah, like for example, I know the sales commissions. Yeah, you want to think of that. We want to actually spend a lot of time to forecasting revenues, relatively to forecasting, let's say, other items like SG&A. Yeah, which are often then, you know, taken as a percentage of revenues, let's say. Yeah. So therefore, first starting point, we project revenues for our operating activities, basically. Yeah. The second step should be that we project operating expenses and we derive the projected income. Yeah, kind of like the idea is then, yeah, as I said, that a lot of the operating expenses, they're just percentages of revenue, or they're pretty constant over time. We learn this from the financial ratio analysis. And so second step, we can then, so to speak, complete the income statement. Step number 3 is then, after we've learned how the performance of the company has been or is projected to be in the next year, we want to now project the operating assets and the liabilities. So we want to look at, as a consequence of more revenue, probably we're going to have more, let's say, accounts receivable. Probably we'll have, let's say, more cash. Yeah, we're going to have probably also more trade accounts payable, etc. Right? So we want to then kind of like continue focusing on those operating assets and liabilities. Operating assets would, however, also include kind of like the long-term assets needed for that. So if we are a company that produces something and we want to grow our revenue, then probably we're going to need to make investments into, let's say, our property, plant and equipment or fixed assets. Yeah, we want to invest into these machines, into the sites, into the stores, whatever it is, right? And this should be, as I said, consistent with the revenue projection kind of like as well. Yeah, so this would be our like third step. The fourth step is then to think about, okay, if we need kind of like, following from the revenue growth, if we need specific investments into our operating assets, respectively liabilities, we can then kind of like continue thinking about, okay, does the company have the necessary funds to back up these investments, right? So we're going to then, if this is not the case, to try to predict basically the future capital structure of the firm, right? So thinking about whether the company will need to take on, for example, more debt, or whether they are daunted to issue new shares, or basically if they even like plan to. So this would be the fourth step in a nutshell. Yeah. Then step number 5 is in thinking of everything that is, let's say, special, that is, in other words, non-recurring. So it doesn't happen every year. So examples here would include things like, restructuring expenses, or maybe this litigation, going on that potentially might affect future financial statements, these kind of things. Yeah. Step number 6 is then we basically, we've completed the projection of the income statement and the balance sheet, and we do like a, final check whether the balance sheet is in balance. Okay, after we've thought about each item separately, usually there is some mismatch somewhere. So we are looking for, let's say, a plug to make our projected balance sheet balanced again. Okay. And to kind of like make sure during this process that we didn't forget anything here. Then only as a 7th step, after we've, so to speak, we forecasted the future balance sheet and we forecasted the future income statement, yeah, using those 2 components, as you probably have learned, we can derive the projected statement of cash flows that we then can use for our valuation, right? So we're not forecasting the statement of cash flows in detail per se, but we're deriving that from the projected statement of the projected income statement and the projected balance sheet. Okay, so here the entire 7-step process is again visualized. Yeah, so to sum that up once again, right? So first we project from the income statement the sales revenue and any other operating revenue that is central to the firm. From that, we try to derive the projected operating expenses and derive the operating income. So we're thinking about items like the cost of goods sold, SG&A expense and other operating expenses. This should lead us to our operating income, let's say. And we kind of like stop here and we start to think about the balance sheet going forward, right? So how will the balance sheet, so to speak, develop into the next year, given what we've projected in terms of revenue and expenses, right? So we try to think about, you know, how accounts receivable might change, inventories, PP&E, intangible assets, cash, and in terms of liabilities, the accounts payable, any accrued expenses, income tax payable, pension, retirement obligations, deferred taxes. So all of these, let's say, operating assets and liabilities. Yeah, after we've done that, in step 4, as I said, we think about, okay, what is the future capital structure going to look like given kind of like the performance and the change in the operating assets, right? So is this, for example, any, you know, debt that the company needs to take on to be able to finance those projected activities, or you know, are they, or is the process simply creating cash flows which the company can use to just simply pay off, like continue to, for example, pay off its debt, yeah? Or we're then also thinking about, okay, are there any plans known to us that the company wants to issue new shares? So if there are, we try to project that in with respect to our contributed equity capital. Some companies do have investments, so they have excessive cash, they put it into either long-term or short-term investments into shares of other companies, let's say. If this is the case, we also try to predict that here. From, let's say, the capital structure of the firm and its investments, we try to then derive the interest expense and the interest income that is generated by those assets. Yeah? Step 5 is then the step I talked about, where all these non-recurring items should be, you know, at least discussed or then included if there's some expectation that there will be some, let's say, one-time revenue or one-time income items or one-time expense items, like, as I said, like restructuring, like litigation losses, etc. For sure, we also need to think about the income taxes that the company is likely going to, you know, to have. For that, usually we kind of like, we look at what the effective tax rate has been over the past few years, and then we try to think about, okay, going forward, whether it's likely to continue to be the case. We then come to net income. So next step, we can think about dividends. So if the company has any specific, let's say, dividend policy that it has implemented. So what we know about dividend policies is that they are usually quite consistent, quite stable. Companies, either when they start to pay dividends, they try to pay a consistent amount or level of dividends, sometimes at a small growing rate. So these kind of items are actually quite easy to forecast. And if they somehow decide to change the dividend policy, usually there's a big announcement. The stock market usually doesn't perceive that as a positive signal, but rather as a negative, that the company has some, let's say, cash constraints. But this is usually well known, right? So you can easily conduct research on that. You know that the net income minus the dividends that explains the change in retained earnings that we observe, right? Okay, so after that, so after we've calculated the change in retained earnings, we have completed the income statement, and we then just wrap up or finalize the balance sheet. So we're basically in step 6 look into whether the balance sheet is in balance, or whether we should, you know, put, somehow a plug into, I don't know, some other liabilities. You know, if there's some small amount left that we didn't really like, that we have trouble with balancing out, then it's considered to be good practice to also solve for that. And then step 7 is then the classic development or computation of the statement of cash flows under the indirect method. So here basically we are starting with net income from our projected net income of the next year, right? And then, as you know, we add back all non-cash income or expense transactions that have been recorded to derive at the operating cash flows, right? And then we turn to our, so you can basically see it here on the left, net income. We had that depreciation expense, for example. We make other adjustments such as changes in receivables, changes in inventories, other current assets, payables, and accrued expenses to get our cash flows from operations. Then we can turn to our investing activities. I mean, after we've, so to speak, projected how property, plant, equipment, and intangible assets will develop, then we pretty much know, okay, what the investing activities are going to be over the next year or years. And so we can also put the necessary numbers in here to get the cash flow from investing. And then finally, we turn to the financing activities, where basically we try to capture our assumptions related to the future capital structure of the firm. So whether they're paying back, paying back their debt, whether they're issuing any new shares, or whether they are paying dividends. This should all be reflected here. Yeah. So this will complete then our statement of cash flows for the future periods. Yeah. And then we can focus on our valuation model. All right. So do you have any questions so far on this, conceptual outline of the approach that we want to take? And before we jump into our first step, which is the projection of the operating revenue. So any questions so far?
No, it's clear.
Okay, thank you, Cassandra. All right. So I gave you, besides preparing for the homework, for the quiz, besides preparing for the quiz, I asked you to work on the FSAP, so the financial statement analysis, let's say, template that I've uploaded on Blackboard. So basically, you can see it here with the completed numbers, right? So hopefully you remember I asked you to basically take the financial statements of Starbucks, right? Which you can see here. Okay, so take the financial statements of Starbucks. So basically the numbers are pretty much down here. See, there they are, right? So here under item 8, we have all the financial statement and supplementary data. So I ask you to, take those numbers, basically the income statement, the balance sheet items, and the statement of cash flow items, and put them into this template here. Okay, so here you can see this Excel template filled out, right? And what I already told you is that, okay, once you fill these numbers in, you'll get something, or you'll get automatically all of the financial ratios that you've been requested to calculate in the previous session, automatically, right? So I did that. You've seen all of the numbers have been then automatically calculated. So what do we learn from that, right? Or basically we've learned already last week that the Starbucks business model is quite profitable, right? So the profit margin is around 15%. The asset turnover is 1.7, And this together leads to a return on assets of 24.2%. Okay, so it's been a very, very successful company. We had, let's say, in 2013, a little bit of an outlier, as you can see here. The profitability was quite low, but basically from the income statement data that we've put in here, we actually can learn that there has been, I think, a litigation. Let's see, that there has been 2013. Oh, 13 was that year, sorry. Yeah, so there's this non-recurring operating gain. So or loss. So the problem is here with the 2013 number. So Starbucks faced a litigation suit here, a litigation loss, which basically have, that quite negatively affected their profitability, right? So this is, I mean, I decided to, because this has been, so to speak, a one-time or non-recurring event, more or less, I decided to put this into row 75, which is a non-recurring loss, okay? And then a nice thing about the analysis is that we have the return on assets calculation basically first based on reported amounts, and then secondly, excluding the effects of the non-recurring items, right? So excluding this one-time litigation loss. And then, if we look at that, then we see that, okay, actually, without that non-recurring item, Starbucks business model was, actually very, very stable over the, even the past 5 years. Yeah. All right. So yeah. So I hope that you've put in those numbers and that you have been able to have a look at the analysis results. So our first task then for today is going to be thinking about the revenue, let's say, going forward. All right. So basically in your case, how this looks like, so I think it's, probably all of this is empty, I guess, right? Okay, so this, okay, yeah. So we wanna forecast this first line item, revenues, right? So we've seen revenue has been growing by 11% from 2013 to 2014, and then by another 16.5% from 2014 to 2015. Yeah, Cassandra, do you have a question?
Yeah, sir, I forgot that we had to do this homework. And so I was wondering if, in order to do the exercises of the class, it would be possible for you to share the Excel.
I can maybe share the data with you. Yeah, I can do that.
And that way we can, after class, I can redo the exercise and compare, but at least we have to follow.
Sure.
If possible,
Sure.
please.
Yeah.
Thank you.
Okay, good. Yeah, I try to do that. Let's see. Maybe I'll just take this one out here. Oh. Okay. Yeah, maybe you can just plug in those numbers then, or just copy this this sheet into yours. Try to save that Starbucks save data sheet. Okay, and I'm gonna send it to you via the chat, and then you should have it. This works. Let's see. Okay. Close this down. Okay, so I sent it through the chat. You can be able to download it, then you can kind of like plug
Thank
it
you.
in, yeah, and then you have that. Then you have the analysis. So our first task, okay, is going to be thinking about revenues, okay. Okay, so could you think of a way of how you would try now to project revenues? So like, what would be your starting point where you would, like, where would you try to look at? Would you like, I mean, what's your idea for that first item here, year one projection of revenues? Any ideas? What's maybe the simplest approach to do?
Just a guess, I will try to calculate the average increasing rate during the year from 2013 to 2015 and multiply it to the numbers of 2015.
Yeah, right. So we could, I mean, it's the most simplest approach. We have no other information. I mean, what we could do, we could say, okay, in the past 2 years, let's say, right, the average, let's say, growth in revenues has been, you know, the average of 16.5 and 10.6, right? So I'll put this into a simple formula here. Yeah, we sorry, it's divided by 2, so it's going to be 1 plus, right? Okay. Yeah, so basically, yeah, the average growth rate is the average of these two numbers. So we'll calculate this quickly. Yeah, it's going to be 21. Okay, no, this one here. Okay, it's 13.6%. So I could just use this 13.6% maybe. Right, and then extrapolate using this rate, and then I will get 21,763. I mean, the simplest approach, just simple extrapolation. All right. Okay. What else could we do? I don't know. Like, how can we become, let's say, more sophisticated, more detailed, maybe, with respect to the revenue forecast? I mean, it might be a good approach for some stable kind of businesses out there. But maybe what is potentially to be different with Starbucks, maybe, if you think about their financial statements? Any ideas?
Could they open new subsidiaries around the world and so have a higher revenue compared to last year because they open new stores and not just growing stores?
Yeah, right. So they're not only growing stores, they are opening stores, as Cassandra correctly said, right? So this might change the whole dynamics of Starbucks going forward. Yeah. So maybe a good start would be first to understand whether this is the case or not, and where they actually, let's say, plan to open up new stores, right? Okay, so where are we going to learn that in the financial statements? Any ideas?
In the MD&A or something.
Okay, yeah, MD&A could be a starting point, right? So in the MD&A,
yes, and I remember they've mentioned something in the notes of consolidated statements. Yeah.
Okay, right. So here we have item number 7, the management discussion and analysis. I'll make this bigger a little bit, right? So I mean, they started with some general text, and then they have some financial highlights where they say, okay, great, we increased our revenue by 17% from 16.4 billion to 19.2 billion. Our global comparable store sales grew 7%, driven by a 4% increase in average ticket and a 3% increase in the number of transactions. They talk about consolidated operating income that was also growing. Operating margin was growing. They talk about the earnings per share, the cash flows, and the capital expenditures. Okay, we also learned that, okay, they have been growing their capital expenditures from 1.2 billion to 1.3 billion. And they have actually, they have some return policy to our shareholders. They basically say, yeah, we return 2.4 billion to our shareholders through share repurchases and dividends compared to 1.6 billion. Okay, so we already learned something about some of the policies the company is doing. But in terms of revenue, I mean, so far we learned it has been growing. So they continue with, you know, discussing their business model. And basically what we learn here, first of all, is that they do have different segments, as they say. Yeah, so basically their segments are different regions in the world where Starbucks operates. Okay, so the first segment is their Americas segment. Okay, and so here they write that the Americas segment continued to perform well in fiscal 2015, with revenues growing 11% to 13.3 billion, primarily driven by comparable store sales growth of 7%, 4% increase in average ticket, 3% increase in the number of transactions, as well as incremental revenues from 612 net new store openings over the last 12 months. Okay, so we learned that basically the revenue growth, okay, first comes from, let's say, different segments. Yeah, one is the Americas. Then they have, we can see down here, China and Asia Pacific segment. And then finally, the European and Middle East and Africa segment, or often called EMEA segment. So we have 3 segments, or actually 4. They have a channel development segment. Okay, we'll come to that later on. So we have 4 segments, and they're thinking of their segments as different, different, let's say, parts of their business. And so they are discussing them separately, which is then actually very, very valuable. Okay, because we learned that, okay, in the America segments, they are increasing, let's say, their prices, and they are also opening up new stores, and they are also kind of like increasing the number of transactions, the number of sales that they are generating. So basically, in other words, kind of like the asset turnover that they are also growing. Okay, if we look at the China Asia Pacific segment, okay, so here we learn that their incremental revenues have increased substantially in this segment, but there's, you know, the primary driver of this was that there was a change in ownership of Starbucks. Okay, so it looks like that they have, you know, they have, so to speak, acquired stores that previously were run as, you know, under a license, and now, however, they run under the ownership of like Starbucks, and this has contributed by 112%, or 2.4 billion with respect to this segment. In addition, they have opened up 767 new stores in this region, so that's even a higher number of new store openings than in the United States. They have increased their store sales by 9%, and this is driven by 8% increase in the transactions. Okay, so also a very successful segment of Starbucks, the Asia and Pacific region. Then the EMEA region, here we see that they are struggling a lot. Okay, so their revenues have actually declined 6% to 1.2 billion only. And this is primarily driven by unfavorable foreign currency translation, adjustments. They do have some revenue growth of 38 million, and they opened up new stores, but here it's an important word, it's licensed store openings over the past years, and not, let's say, stores that are operated by Starbucks themselves. So it's more of these franchise store openings that have partly offset the overall general revenue decline in this segment. Yeah, and then the final segment is the channel development segment. Okay, what they mean by that is, it's kind of like the other distribution channels that they have, like, selling Starbucks branded products through, let's say, grocery stores and things like that. Okay, so here we learn that their segment revenues grew by 12% to 1.7 billion, primarily due to increased sales of premium single-serve products, the key cup portion packs, and improved packaged coffee sales. Yeah, so we learned that there are 4 segments, and the 4 segments, in a nutshell, right, they develop differently. Yeah? So Americas is like the biggest one, right? So we learned that the Americas, right, is 13.3 billion of revenue overall. Yeah, so out of this 19 billion revenues, 13 comes from the US. So it's the biggest market for them. And the second biggest market is China, Asia Pacific, 2.4 billion only, but also growing strongly. Then we have the EMEA. That's the smallest segment, 1.2 billion and declining. Yeah, and then the channel development, 1.7 billion, but also increasing, right? So if we learn that, okay, then actually it makes sense to, when it comes to revenue forecasting, to try to, forecast each of those segments separately. Yeah, and then only in the end aggregating it to that one number, which is our projected number for 1 year ahead, so the 2016 number. Yeah. Luckily, yeah, for that we also get one other very important paragraph, and you can see it here. Like Cassandra said, there is fiscal 2016 and an outlook of view ahead written by the management. So they write the following. So for the next year, we expect revenue growth in excess of 10%, driven by strong comparable store sales, slightly above the middle single digits, the addition of approximately 1,800 net new stores. Okay, it's on a global basis, and the effect of a 53rd fiscal week. I don't know if you heard about this, but in some of the years we do have, let's say, an additional week. Yeah, so it comes the reason for that is the way we kind of like measure, kind of like starting point and ending point of a week. So in financial terms, sometimes there's this 53rd fiscal week effect present. So the effect of one additional week. Okay, we'll come to that later, but just so that you know what this means, which is expected to contribute to an incremental 2% to our revenue growth rate. Yeah, so we want to open up 1,800 net new stores, and there's another 2% revenue effect from this 53rd week, so from this additional week that we're going to observe in 2016. Approximately, now it's an important part, 1/2 of net new stores opening will be in China, Asia Pacific. 40% will be opened in the Americas, and the remaining store openings will be in the EMEA segment. Okay, so you can already see, right, that they want to grow the most in China, Asia Pacific, yeah, followed by the US, and then only by the European and Middle East, Africa market. Okay, so this is information. I mean, the question is, okay, is this information that we can use actually when we think about detailed forecasting of our segments? And I think that we can use it if, let's say, previous years have shown that you can trust those projections. Yeah, so in this case, I mean, if we are really new to the Starbucks business analysis, I mean, what we should do is we should go back to, let's say, the financial statements of 2014, 13, 12, etc. Look at the projections there, and then compare it to the actual new store openings that they have reported subsequently to that. Yeah, and if this is in line, and I can already tell you for Starbucks, it's pretty much in line, so with that we can actually trust those projections. Yeah, then it's actually very helpful for our projection going forward. Okay, all right. So so how do we, I mean, like how should you combine this in the, let's say, in the forecast development, basically? Yeah, so yeah, as you can see, I mean, there's a forecast development tab here, which is, in your case, it's probably blank, but that's fine. My recommendation, forecast development. My recommendation for your forecast development is first that you split it up into 4 segments. So you want to forecast each of those segments separately, right? Using the outlook that the management has stated, which is an outlook for how many stores, right, Starbucks is going to open. Yeah, of course, then the quantity of stores is not enough, right? What we need to know is that how many stores are already running in the respective regions. Yeah, first of all, and then secondly, how much are they making in every store in a respective region, right? So where do we get this information? And we also already heard that, I think, from Cassandra, that it's in the notes, basically, right? So when we scroll down to the notes, which basically already start here with the segment information, we do see information on the first segment, which is the Americas, right? In terms of first, the revenues that the company, that Starbucks has been making, split up into company-operated stores, licensed stores, and then food service and other. Yeah. If we scroll down, then it follows the China, Asia Pacific, net revenues by company-operated stores, licensed stores, food service stores. The same for EMEA, okay, and then finally for the channel development. Okay, so we do get the net revenues that were generated in detail in each of those 4 segments. So the only other thing that we need is, of course, the number of segments that Starbucks operates in those respective regions, right? And actually, the very beginning of the financial statements, we do get this information, right? So we do get how many company-operated stores there have been in the Americas, China, Asia Pacific region, EMEA region, and the other segments. Okay. We also get the same table for the licensed stores. Yeah. Okay. So what we can do with this information, and I also want to give you this as a hint, we can build up the revenues that the company is, so to speak, generating on a per store, let's say per year basis, yeah, as follows, right? So for the Americas, right, we do see the total stores that were in place over the past 3 years. We also get the information from the Starbucks table, how many new stores have been opened. Okay. And now we can combine it with the revenues in that Americas segment in order to learn how much revenues they are making per store per year, and how much these are growing. So we see that in the Americas, they make 1.4 billion revenues per store, and this has been growing by almost 6%. In the licensed stores, yeah, they are making much less per store per year. You can see that for the licensed stores, they are making only 224 million per store. It's on a high growth rate, but it's of course on a per store basis much lower than if they run their stores by themselves, right? Because they only get franchise commission fee and nothing else. Okay. In terms of the China and Asia Pacific region, we learned that, maybe I can draw this here. We learned that here on a per store basis per year, they are making 926 million per year. Yeah, so again, we can compare this to how much they are making in the US. So they are, let's say, like more successful in terms of revenue in the Americas on a per store basis than in the Asia Pacific region. Yeah, also with respect to the revenues per store for the licensed store, yeah, it's 96 million compared to 224 million. Yeah, with respect to the EMEA region, revenues per store per year 1.173, higher than in Asia Pacific, but lower than in the Americas segment. And for the licensed stores, 174 million. Okay, why am I showing you these numbers? Okay, I mean, we have a projection from the management. They want to open up 1,800 new stores worldwide, and half of it should be opened up in, let's say, China and Asia Pacific region. Okay, so what I would like you to do is kind of like to rebuild this table in your forecast development, because these are first the actual numbers. And then, yeah, going forward, yeah, for the China and Asia Pacific, right, we know that, okay, we want to add 900, which is 50%, new stores to this region. Okay. And then, of course, as we do that, the number of total stores will increase, right? So it will go up as we include new stores, right? And then you can go ahead and multiply it with the revenues per store that you expect the company, the Starbucks, to make in this region in a year from now. Okay, so this could be just the number that you see here, but maybe, given that they are probably going to also have a growth rate in terms of their revenues per store, maybe it's a number that's maybe slightly higher than that. So you might think and discuss how much higher this number could be or could become. Okay, and then you repeat that process for let's say the Americas, for the EMEA, and for the remaining channel development. Okay, good, right? So questions before we get started. So any questions on how you should approach that?
And we do this in the Excel?
Yeah, I mean, the simplest thing is, yeah, you just go to the, Excel, so you focus development, and you start with the Americas, yeah. And basically, my idea for the starting point is that you go ahead and unfortunately I don't have these numbers, and then you basically you start with okay, what are the in fiscal year 2016, right? So maybe I'll write 2016, so it's our forecast year +1, right? 2016. You start with okay, what are the net new stores opened during the year for the Americas, right? In terms of the, move this up here, in terms of the company operated stores, right? And then the licensed stores. Yeah, going forward, I mean, we learned that it's probably something around, and it's 40% should be opened in the Americas. We learned that from the projection of 1,800 stores. So in total, it's roughly 700, one can say. So we could go ahead and say, okay, maybe we open up 350 new as company operated stores and 350 as the licensed stores. Okay, so this would be my approach. And then basically, yeah, you go ahead and then you say, okay, then how many total stores are they operating in, or will they operate in the following year? So in 2016, right? So basically, right, the starting point is, I mean, they had 806.71 stores in the year before, okay? And now there are new stores that are going to be added, and basically the new stores that they are going to add are, this 350 I projected here. And then, so they will have in 2016, 1 year from now, they will have not only 8,671, so we won't have this number, but we'll add those 350, for example. Okay, and so we'll have 9,021. Yeah, so we start off with projecting, okay, how many stores will there be in place going forward? Yeah, maybe 1 year from now, and then you can, I mean, we don't have an outlook beyond that, but maybe you can still, continue with thinking about the year after, so 2017, for example, up until, so usually it's considered to be good practice to try to come up with with a 5-year forecast of the numbers, kind of like going forward. Yeah. So maybe I also can include the base year here, that we have all the numbers that present. It was 8,671, I think, stores, right? Yeah, okay. And then once you have the stores, then you can go ahead and you can think about then the revenues, basically, right? So the revenues that they are making going forward. Oh, sorry. First, the company operated, and then the licensed stores. And all of the licensed stores. Yeah, so in 2015, their company operated revenues in the Americas are 11,925.6, and then this is the total, and this is just maybe down there we write the company operated per store. Yeah, which was 1,398. Okay, so basically here, I think we can take, this number divided by the number of stores that they running. I think, yeah, by year. Yeah, so it's everything in billion. And so this is how they are making 1.3 billion per store, let's say. Yeah, and then you can think about, okay, going forward with the new number of shares, yeah, what will be the company operated number that they're making per share. So maybe it's the same number. Maybe you expect, okay, last year we've been growing it by roughly 7%. So maybe they're also going to grow it by 7%. So the company operated so will be a little bit higher. Okay. So maybe we'll go up to 1.47. Okay. So then I can project the company operated stores going forward. And by taking the new total number of stores times the newly projected, let's say, company operated revenue per store. And then I have my projection of the company operated revenues going forward, so to speak. Yeah. Maybe one important tweak I would like to tell you, okay, it's not likely that this 350 new stores will be opened up immediately on January the 1st. It's more realistic to assume that they are gradually added throughout the year, okay? And therefore, it's considered to be good practice to basically say, okay, I mean, during 2016, the number of total stores that the company operated, it's not 9,021, but it's rather the average of how many have been operating at the end of 2015 versus how many have been operating at the end of 2016. So I would change this formula here slightly by, you know, adding, so basically calculating the average of the number of stores that were in place in that segment, company operated, between 2015 and 2016. Yeah, so I would put it in like this. So this would change the number slightly to 13 billion, let's say. Okay. Did it make sense to you? But this is kind of like the approach that you should kind of like try to go for. And then we can compare it, right? Then we can try and think about it and, you know, comparing it to our simple, you know, extrapolation of 13.6. You know, the number that we've projected here. Okay, is that fine with you?
Yeah, and we do that for the 3 regions that you said, Asia, Americas, and
for the 3 or 4 segments, right? Don't forget the channel segment. But basically, for the 4 segments, you do this, and then in the end, you need to aggregate all the numbers through all the segments and all the different, let's say, channels here, because we have, as I said, we have the own run stores, the franchise stores. Yeah, so they have basically two channels. So maybe I'll open up, right? We have, I mean, 6 groups. I let you choose the room. So maybe you can already get together with your group teammates that you usually work with this time. Okay, so I hope you still remember those. Yeah, so this would be my recommendation, because I think, yeah, this is already a preparation for kind of like the take-home assignment that we'll have, which will be kind of like a similar task, right? So I really want you to kind of like understand the process from, you know, from the very details, so that you then as a group can also do it for any other company that we're going to cover in the future. Okay, so 6 breakout rooms I'm going to open now. So you can join those and work on the forecasting of the revenues, and I will you know, go around the breakout rooms and try to help you as needed. Okay.